Hello everyone, this is Vilas. In this video, we'll try to understand day 1 cash flow statement. So in the last video, we have created our day 1 profit and loss statement which look like the page in front of you. So we had revenue of 2000 rupees, then there were certain expenses, and finally we had a profit of 276 rupees. Now the big question is, did we actually earn the cash of 276 rupees? The short answer is no, and the reason is that even though we had earned revenue of 2000 rupees, or there were certain cost items, there was no actual cash movement. That's why we would be creating our cash flow statement to understand how the cash movement happened. So let's get started. We received revenue of 2000 rupees, but did we receive all of it in a cash? So if you go back and open your notebook, you would notice that there were no payment for 25 teacups. The customers, those were your friend, they told you that they will pay later because they did not have cash. So that 25 teacups revenue was to be paid later. Basically, you would be receiving 250 rupees later. This delayed revenue is called receivables, and this is very important financial concept. Thus, we have receivables of INR 250. We haven't received this 250 rupees in cash. The cash which was supposed to come in did not come in, so that's basically cash outflow. So what we'll do is subtract this 250 rupees from our PAT. Now that we have taken care of revenue, we'll go through each and every cost line item to understand whether there was a cash movement or not. So let's understand COGS. We said that the COGS was 800 rupees, but was actual cash movement? The answer is no. So what we did was, we had our material already purchased, and what we did is we just went there, took some sugar, milk and tea powder and boiled our tea. So basically there was no cash movement while boiling the tea. Add back this 800 to the PAT. The another expense was salary of 500 rupees. Was there actual cash movement? Yes, we actually pocketed this 500 rupees. So we do not take any action here. The utilities was rupees 100. Was there cash movement here? No. The reason being, we would pay these utilities at the end of month. Here we are just making a provision for that expense. So we add back it to the PAT. Similarly, the rent was 200 rupees for day 1. But since we will be paying the rent in cash at the end of month, currently there is no actual cash movement here. So we add back it to the PAT. Then the interest was 7 rupees for day 1. Similar to the rent, there was no cash movement. We add back it to the PAT. Finally, we were expected to pay tax of 92 rupees. There was also no cash movement here. We will pay this tax at the end of quarter or annual year, hence we add back this to the PAT. Finally, we have this D&A, which is depreciation and amortization expense of 25 rupees. So this is just a notional cost we have calculated for day 1. There was no cash movement here, so we add this back to the PAT. Now these are the expense items, and we understood where there was a cash movement and there's no cash movement. Let's analyze this little bit further. So this COGS of 800 rupees, if you notice, we have already paid cash for this and we don't need to pay extra cash. These expenses of utility, rent, interest, tax, these are yet to be paid in future. Something which is yet to be paid, we call it a payables, and the total value of payables in our example is around 399 rupees. Please note this term payables. It is one of the important financial terms. And finally, D&A, which is 25 rupees. It is already paid, and this is just a notional expense which we have taken for day 1. Now that we understood where there were cash movements, let's put all this in our cash flow statement. We take PAT of 276 rupees and we subtract receivables of 250 rupees. Then we add back COGS of 800 rupees. Then we add back payables of 399 rupees. And finally, we add back D&A of 25 rupees. If we do the math, you will get that cash flow from operations, that is CFO, was around 1250 rupees. And since this cash was generated as a part of operations day 1, we have labeled it as CFO. If you remember, there are two more categories of cash flow statement, that is CFI, cash flow from investments. Did we make any long-term investment on day 1? No. Therefore CFI is 0. There is another category of cash flow which is called cash flow from financing. Did we borrow any loan from the bank? No. Did we repay any loan to the bank? No. Did we put our own money in the business? No. Therefore, CFF is 0 for day 1. Finally, if we add CFO plus CFI plus CFF, you will get net cash flow of 1250 rupees. This is the actual cash flow for day 1. If you actually want to know how much cash money you have generated on day 1, this is the number, that is 1250. If I put this table in a standard format, it will look something like on the page. Take a pause and have a look at it. That was our day 1 cash flow statement. In the next video, we will also create our day 1 balance sheet. I will also request you to subscribe to this channel so that you will get updates of future video uploads. Thank you and have a great life.